Bukari Adwin. I'm your tutor for corporate financial analysis. In this particular unit, that's the final unit for the course, we'll be studying valuation models and human resource accounting. Now, in session 1, we'll be dealing with the factors that affect valuation, the various elements of business valuation, and also we'll finally discuss asset-based valuation. And by the end of the session, you should be able to explain the various principles of valuation and also discuss the need for these principles. We would also make mention of the internal and external factors that affect valuation of a business and also the elements of business valuation. As we mentioned earlier, valuation is done to know how much an asset is worth. Okay, and these are the value or the worth of an asset is based on a number of factors. Okay, there are a number of factors that can determine the worth or the value that we place on a particular asset. Now, although these factors vary, there are some that are within the control of the company and some that are beyond the control of the company, and therefore the company cannot do anything about it. So those factors within the organization that affect valuation or the worth that is being placed on the asset of the company is known as internal factors, and they include the rate of dividend declared. Like we mentioned earlier, the company is at its own liberty to determine its dividend policy. Okay, so the rate of dividends that a company chooses to declare over a period of time is within the control of the company, and therefore it's an internal factor. Also, when it comes to goodwill and also industrial relationships or relations with employees, they are also within the control of the company. The nature of plant and machinery, expansion policies, and also the reputation of management is something that the company has control over, and they are all factors that affect valuation. Now, when it comes to those factors that's beyond the control of the organization, and therefore there are factors outside the organization that the firm has little or no control over. However, they affect the value or the worth that is being placed on the assets of the company. They include relationship with government agencies, competition, the competition within the industry or the markets, technological developments, import and export policy when you have to deal with a multinational company, and also the stability of the economy and the stability of the government in power. The company has no control over the economy, over inflation, over interest rates, or exchange rates, and therefore, in as much as all these factors affect valuation, they are beyond the company or they are outside the organization, and therefore the company has no control over them. Now, there are several elements of business valuation. Business valuation is simply the processes and the set of procedures that are used to determine the economic value of an owner's interest in a business. So these elements of business valuation are the economic conditions, 2, the normalization of financial statements, and 3, the valuation approach. Now we will discuss these elements into details in subsequent slides. So when it comes to economic conditions with the portfolio management theory, it follows the EIC approach. Okay, the E representing economy, I representing industry, and C representing company. In our earlier discussions that we made mention that if you want to undertake any analysis, ideally you should examine the economy first before you come down to the industry, and then finally you can analyze the company. This same method is what is adapted here when it comes to the economic conditions, has an element of business valuation. So you need to understand the broader perspective of the whole analysis that you want to do. You have to understand the national or international regime, you have to understand the national regime, the regional and also the local conditions that exist at the time of valuation, as well as the industry conditions, which is subject in which the business operates in. That is also very critical. So you want to look at, in broad terms, the international market. Then you would want to look at the national economy as well. Then you come down to the industry. Then you can finally make good valuation judgments on the company you want to value. So, for example, when it comes to economy, you look at the general market thing. How is the economy doing? How is employment? How is investment activity? How is production? How is interest rates? What are the interest rates, exchange rates, the level of inflation? You would want to consider all these things. Then you come down to the industry. You would want to look at the competitiveness of the industry, suppliers having more bargaining power, or consumers having more purchasing, like the purchasing power of consumers. Do they have a lot of bargaining power? You would also want to consider if there are threats to entry, if there are barriers to entry, or you want to know the whole nature or how the industry works. Like Wade mentioned, if it's easy for new firms to join, then it's most likely that profits within that industry will decline over time. Other industries that have very strict barriers to entry, you would know that they tend to enjoy more profit for a longer period of time. So you'd want to consider all these things. And also you'd also want to consider the nature of goods that's in the industry. Are they substitutes? Are they complementary goods? You want to analyze all these and look at the existing economic conditions. Generally, are consumers having higher purchasing power, or are the purchasing power of the consumers decreasing? What are the future prospects of the company in that regard? Then you come down to the company itself and you analyze it in that manner. Also, the next element of business valuation is the normalization of financial statements. We make mention that the primary or the basic source of information to undertake any form of analysis is the financial statements. Now you need to understand that the financial statement has to be normalized for a number of purposes. First, and they include undertaking a number of adjustments: comparability adjustments, non-operating adjustments, non-recurring adjustments, and discretionary adjustments. Like we made mention earlier on, financial statements include a whole range of information. Therefore, you need to pick which ones are very necessary, and that's why sometimes it's necessary to reformulate the financial statements. And when it comes to the comparability adjustment, this is done in order to facilitate comparison with other organizations that are operating within the same industry as the company or the business you are trying to value. So you know that comparability is one of the qualities of financial statements, your ability to make comparison between companies or firms within the same industry. And also you'd want to exclude non-operating adjustments, okay? And you'd also want to take note of items of expenditure or income which are non-recurring in nature, and you'd want to exclude them in order to also help you make better comparison between various periods. Also, discretionary expenditures are also to be scrutinized and adjusted to arrive at a fair market value. So if there was a contingent asset or liability or a discretionary expenditure that had to be incurred, you would want to critically examine that and adjust them to make sure they are at their fair market value. The third element of the business valuation is the valuation approach. And there are three basic approaches to business valuation. They are the discounted cash flow valuation, the relative valuation, and the asset-based valuation. Now, each approach has its own technique for arriving at the fair market value of a business, okay? And usually it's not ideal to depend on a single approach because they all have their advantages and disadvantages. So you'd want to weigh based on the purpose of the valuation you're undertaking, the company, and other factors before you decide which approach you'd want to use. So we discuss the asset-based valuation. Now in this method, you make a list of all the company's assets and liabilities and you revalue them to a standard value, such as the fair market value, the fair value, intrinsic value, or any other representation of standard has a going concern. The going concern principle we know states that you view the company as though it would continue into the foreseeable future. In other words, the company is going to survive or be in existence for a number of or for a period of time, and therefore the goal of this approach of valuation is to generate a true picture of the accounting axiom or the accounting equation: asset is equal to, or asset minus liability is equal to owner's equity. So this is the reason why you do the asset-based valuation. You want to know the true state of the firm. And this method may be very cumbersome in large companies, especially when you have a number of assets and liabilities and you have to take each one of them at a time and revalue them. It can be quite cumbersome to do. So like we made mention, the asset-based valuation deals with revaluing the assets and the liabilities of the company. So when it comes to the assets, we know we have current assets and non-current assets. So you value each item of them. Now we'll take them one at a time and discuss how the revaluation is done. So cash is cash. There's no problem with valuing cash. If you have a cash of 100,000, it is 100,000, and there's no two ways about it. When it comes to debtors, you have debtors when you sell goods or you provide services to your customers on credit, and therefore you'd want to value your debtors at their face value. Inventories exist or can be in existence in three different forms. Either they are raw materials, they are work in progress, or they are finished goods. So raw materials may be valued at their most recent cost of acquisition. Work in progress may be valued at the or may be valued from the cost point of view, and you'd want to value finished goods by determining their sale price realizable less the cost of packaging, transport, or the cost to sell them. Now, other current assets such as bank deposits, prepaid expenses, and accruals are valued at their book value. That's the value that has been recorded for them in the books. When it comes to tangible non-current assets, that includes the land and building, plant and machinery, fixtures and furniture and fittings, or fixtures and fittings there. So you value land as though it is vacant and available for sale. Buildings, plant and machineries are valued at their replacement cost less the cost of deterioration. When it comes to intangible non-current assets such as patents, goodwill, and all that, they will be very cumbersome to use the market approach because you cannot sell them or disassociate them from the business and sell them separately. Therefore, they come with the business. So you would want to value them using the cost approach, or how much it costs the business to actually acquire them, or the income approach based on the economic benefits that you'd be receiving from them. So ordinarily, either you use the cost approach or the income approach to value the tangible non-current assets, since the market approach is not at all helpful. Now, when it comes to liabilities, we have long-term liabilities and also short-term or current liabilities. So with long-term debt, you have the long-term loans and debentures, and you would want to value them using the standard bond valuation model. Current liabilities and also provisions are valued at their face value. So they consist of the short-term borrowings from banks, accrued expenses, the amounts that are due to suppliers, advance payments received. You value all of them at their face value. Now, the total value of ownership is simply the difference between the value of assets and the value of liabilities. Like the accounting equation says, equity or capital is equal to assets minus liabilities. So the difference between the value of your assets and the value of your liabilities will become the value of your equity or your total ownership. So in this session, we discussed the internal and external factors that affect business valuation. We discussed the various elements of valuation and also the various ways by which we can value assets and liabilities using the asset-based valuation. Thank you.